What's up, guys? Your boy Quick Stocks is back. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of...
Who's that company?
It's Netflix.
Netflix, ticker symbol NFLX, trading for $438 a share as of May 21st, 2020, with a $193 billion market cap and an insane PE or price per earnings ratio of 89. So what's the move? Should we switch to Disney Plus, or is it time for us to chill with Netflix? This is your quick stock analysis. So of course, Netflix is a media service provider and production company. It only seems fitting to knock it out of the way first. For companies such as Netflix, the current crisis has represented a boom for business. The video streaming subscription-based media company reported a record 15.7 million new subscriptions during Q1 2020, bringing their total paying subscribers worldwide to over 182 million, which of course is significantly higher than the 9.6 million new subscriptions seen in the same period last year, and revenue grew 27.5% year over year, while net income more than doubled from 344 million to 709 million US dollars. The question is, once the lockdown is lifted, will people still stick around? Honestly, I would assume Netflix will see a high retention rate in their subscriptions, as once people sign up for the service, they have a tendency to stick with it. However, Netflix has paused most of its new content production around the world, which will certainly cause a disruption for the company's content production cycle, limiting its library of original programming. And one could certainly argue that with people having so much extra free time, customers may binge content on the platform at a faster rate, depleting existing customers' desire to hold on to their subscription after exhausting the Netflix library of content. Although, with lower capital expenditures in the near term, the company has also started generating free cash flow, with close to $160 million generated in the last quarter alone. Which, for a company the size of Netflix, that really isn't that much. But you must understand, it's a substantial improvement from the previous quarters. However, pump the brakes. Netflix investors shouldn't get too pumped yet. Their debt burden is expected to remain high, as Netflix needs to continue to spend on new content, in which it may even need to borrow more to fund its content creation in order to stay ahead of its competition. Honestly, in this humble reporter's opinion, I don't know if Netflix will ever have that luxury. The big boy competitors such as Disney, Hulu, Amazon, Apple, and many new competitors such as Quibi, all fighting for a piece of the video market share. And don't get me wrong, the previous stated companies are certainly competition, but in the coming decade, I think the real competition is going to come from companies like YouTube, Twitch, and TikTok, or whatever their successors may be. Gen Z, people ages 7 to 22, are already more likely to watch videos on social media rather than Netflix. And the two most popular platforms currently are Instagram and YouTube, with the up-and-comer TikTok gaining substantial market share, as people are starting to see user-generated content or influencers as more relatable and reachable than big celebrities. Obviously, high-quality movies and TV shows will always have a place in our culture, and I don't think the Bears are saying high-budget movies are going anywhere. But people have a finite amount of free time, and all of these companies are fighting for consumers' eyes. And considering platforms like YouTube have a niche for any interest under the sun, the explosion in popularity of live streams, and they're free. One could definitely argue that Netflix could have an uphill battle if these cultural trends continue. So, with all of this in mind, what's my move? Well, I can certainly agree streaming media is the future, in which Netflix still has tremendous upside, especially worldwide. However, we've already got a lot of money in the big tech sector, and half of them introduce us to the video streaming or related markets such as Google, Amazon, Snapchat, Facebook, Tencent, Baba, and Disney. Speaking of Disney, I do see the rest of Disney's company being a drag, at least in the short term. However, the idea at current prices, Disney's and Netflix's market caps are relatively similar blows my mind. The idea that just a few weeks ago Netflix was worth more than Disney is kind of crazy to think about. And take it as a grain of salt, but in my own personal experience, coming from an OG Netflix fanboy, Hulu has won me over, and I have no doubt Disney Plus is going to continue its massive tear, and I see most families with children getting a Disney Plus subscription. It just seems like, at current valuations, Disney is a better play. And don't get me wrong, I'm certainly not hating on Netflix, and no one can argue that they've changed our culture. It's just, at its current value, even other big tech companies such as Facebook, Microsoft, Google look like a better play than Netflix, at nearly $440 a share. Anyways guys, this was your Reporter Quick Stocks. As always, the best investment you can make is to go long on Quick Stocks. Hit that subscribe button now at 220 subscribers and plan an early retirement. I'll catch you guys in the next one.